Today we're going to be talking about the truth about long-term investing, and we're going to prove through statistics why long-term investing is the way to go and how anybody can build wealth over a long enough period of time. Because there's a lot of common misbeliefs that the market's rigged, only the wealthy people win, you need a lot of money to make money, it's a gamble, etc. Right? There's a lot of different false beliefs out there. And in this video, I'm going to break down through statistics and mathematics how the average person can build wealth in the stock market with minimal risk. Investment plan example number one. We're going to look at an investor's total annual income, and we're going to look at their liabilities, such as their bills, their yearly free cash flow, their current cash savings, and their monthly free cash flow, and break down some facts and statistics and build a financial plan, or we could say investment plan, to fit their financial situation with the most minimal risk way possible. So let's jump right into it. So the investor's total annual income in this case, we're going to say is 80,000. Of course, if you're looking to implement this yourself, you're going to adjust the numbers to your own financial situation. But for the example's sake, we're going to move on. So the investor's total annual income is about $80,000. Let's highball and say that the investor's bills are $40,000, right? So he spends 50% of his income on liabilities such as bills. Now, his yearly free cash flow that he's left with is $40,000 after bills are paid. Now, the current cash savings is about $20,000 that he has in the bank, right? Now, his monthly free cash flow after he's done paying his bills is $3,300 a month, and this equals to $40,000 in free cash flow, right? So now that we understand his finances, let's look at a couple facts that we need to consider here. So you're losing 7% a year to inflation while money sits in the bank collecting dust, in which the bank invests your funds, which you're failing to do, right? So now the bank pays you, let's say, 1% interest on your money, but inflation is roughly 7% in the year 2022. You're still losing 6% a year, right? Because inflation's 7% and the banks are paying you 1%. So either way, you're still losing. Now, the third is the average annualized stock market return is about 10% for the past 100 years. Now, this is annualized. This isn't every single year, right? We could have years where we're up 20%, years where we're down 5%, years where we're up 15, 20%, years that were down 6, 7%, 10%, right? It happens. But annualized over the past 100 years, the stock market averages roughly 10%, right? So now the odds of losing money over a 20-year investment period in the stock market index is 0. And I'm going to prove this through statistics in the slide to come. Now, number 5 is the stock market has always recovered economic downturns, such as crashes, pandemics, and numbers and historical charts do not lie about this stuff, right? So let's jump right into the next slide. The investment recommendation number 1 to consider is step 1. We're going to invest $10,000 into a total stock market index ETF, right? This leaves us with $10,000 in cash savings. Why is that? Because using the investor example number 1, our current cash savings is $20,000. We're going to invest $10,000 into the total stock market index fund. This leaves us with $10,000 in cash savings. Next, we're going to set up reoccurring monthly investments of $800 a month, assuming that we're going to invest $9,600 annually, right? Now, this leaves us with $2,533, let's round it to $2,500, in monthly savings cash after paid bills, which allows you to save around $30,400 a year in cash while you already have 10K saved up in the bank as a sense of safety and comfort. Now, let's make sense of this, right? So we know that our bills were 40,000, but our yearly free cash flow is 40. Our monthly free cash flow after all bills are paid are around 3,300, right? 3,300, assuming that we're going to invest $800 a month, subtract that $800 a month from our 3,300 in free monthly cash flow, and that leaves us with $2,500, right? Now, this is after bills are paid and after our investments go out. So now, when we could save up $2,500 a month, this equates to about $30,400 a year in cash savings while we already have 10K saved up in the bank as a sense of safety and comfort. Okay, now step 2 is while we're implementing this plan for 1 year, from let's say January 1st, 2022 to January 1st, 2023, you will have $30,400 in saved cash plus the $10,000 left after the initial $10,000 investment in the first place, right? So this brings us to our total cash in the bank is around $40,000. Our investments will be 9,600 in recurring investments, right? Because we're investing $800 a month, which adds up to the 9,600 per year. Plus, we had the initial investment of $10,000, which equals our total invested amount of 19,600 in our first year, right? So in our first year, we saved up a total of $40,000 in cash, and we've invested $19,600. So now, if we repeat this for 2 years, by January 2024, we will have a total of 70,800 in cash savings and 41,600 already invested in the stock market. Now, keep in mind, this is just with contributions, not including capital gains or any losses that could incur in this short time period. Now, why do I say losses are possible? Because in a short time frame of a year or two, we never know what's going to happen. If the market's going to go up, down, sideways, we don't know. But when I say we're long-term investing, our goal is on at least minimum 5 years. But me personally, when I think long-term, I think 10, 15, 20 years minimum, right? So if we're investing, if we look at the facts from before on what is this? Number 4, the odds of losing money over a 20-year investment period in the stock market is 0. And I'm going to prove this. So moving back to the next slide, what are some worst case scenarios that we could be looking at, right? Because there's always going to be risk, and we always want to know the risk before getting involved. Now, what if the stock market crashes, someone might ask? It will crash again and again, many times over. But in the long term, markets always go up, and history proves this, as I will prove it through charts and statistics in a few minutes. Now, number 2, what if the stock market never recovers? The stock market will always recover, no matter what economic or political events take place. History always proves this, as I will show in the coming slides. Number 3, all right, let's say you finished year number 1 of your investments and savings, where you arrived at total cash savings of $40,400, and your total investments arrived at $19,600. Let's talk about a possible scenario. So let's say the stock market crashes 50%, right? Oh my God, the stock market crashed 50%. Now, what happens? Your invested capital drops to 9,800, right? Because your total investments so far are 19,600. 19,600, when it loses 50% of its value, drops to 9,800. Now, this is okay because you have to realize you have $40,500, $400 in cash savings, right? This is not fluctuating with, market moves up and down. So your cash is safe. Your cash is what is keeping you, comfortable. That's going to be your source of ammo when either markets go down or you just need extra cash or reserves, whatever the case may be. So that 40,000 is meant to dig you out of holes if needed. You're so now in this scenario, the reason you have nothing to fear is because your bills are paid, you have a solid savings saved up, and you're still investing $800 a month to dollar cost average down your investment to cheaper prices. In this way, when the market goes back up, you're making profit at an accelerated rate due to having more assets purchased at a lower price. Now, if you guys seen my last video, which I'll actually tag a link to in this video, is dollar cost averaging and how everybody should do it and how it's the most passive way to invest over a long period of time. It keeps the investor completely hands off and is very, very significant in building wealth over a long period of time. So I'm going to leave a link to that right in the top right hand corner. So next we're looking at what is your real risk? Your initial capital risk, right? It lowers the further price moves away from your purchase price due to you being able to put stop loss orders to eliminate 100% of initial capital risk and only risk your profit. Now, what does this mean? So let's say you purchase an asset for $100 a share, right? And now over time it moves to $200 per share. What you could do is you could set a stop loss order at $100 per share. So if the market ends up going, crazy and it crashes, right? And let's say it hits that $100 mark, you could sell everything for a break even and you don't lose a dollar. So you only stand the chance to make the upside and you eliminate the downside, right? This could be done years down the line as price moves away from our entry point, but I do not recommend this within the first year or two, right? Because one, if you buy something for 100 and it moves to 120, you don't want to push your stop loss to a break even because it's most likely going to stop you out prematurely and you're really going to miss out on a lot of upside potentially, right? So with that being said, if you're long-term investing, you shouldn't be worried about placing stop losses, eliminate, right? You could do that later down the line, but your initial goal should be to really ride out the market ups and downs along, along a sustained period of time. Now, with that being said, it's all about what you invest in, right? If you're going to be buying penny stocks, bullshit companies that aren't making any money, right? You're going to do poorly. But if you put your money in, again, I speak about this in my previous videos, into index funds, which track the overall benchmarks of the S&P 500, the Dow Jones, the Nasdaq, right? You're going to do well over time. You're going to do well over time. So now let's look at how. Stock market since the 1900s, right? If we look at the 1900s, we could see all the way back to the Progressive Era, World War One, the Roaring Twenties, Great Depression, all these different types of wars and economic, events that have taken place all the way up to the global financial crisis of 2008. Now, yes, this chart doesn't come all the way up to 2022, but as we all know, there was another crash in 2020. And guess what? We've made all-time highs in that year as well. So with that being said, over the past 100 years, we have always made higher highs no matter what. Yes, we've had periods of temporary downturn, such as, let's say, 1929 major Great Depression, the market crashed about 83%. But guess what? Over the next 20 years, we ended up making all-time highs, right? Now, let's take a look at the next chart. Now, let's say we implemented the investment scenario that I just spoke about. Our initial investment was, say, $10,000. Now, let me just say something before moving forward. You don't have to have the initial investment of $10,000. If you only have, a couple $100 to start, that's fine. You could do an initial investment of zero and only invest $800 per month. That's completely fine. I'm just using $10,000 for this scenario, right? So let's continue forward. So our initial investment of say $10,000. Our monthly contribution is $800 a month. Our length of time in years is going to be 20 years, right? Minimum, we're going to look to invest for 20 years because that's that's the time frame that eliminates a lot of our initial capital risk, right? Now, our estimated interest rate, or we could say rate of return, is about 10%. So now the result in 20 years by doing this is $617,000, right? Over the course of 20 years. Now, what was your initial contributions? Let's look. So in 20 years, your total contributions would add up to 202,000, right? And in that 20-year period, it'll be worth 617,000. So in just a 20-year period, you tripled your money. You tripled your money. Now that's only off of putting $800 a month away. Of course, as the years go on and you can afford to invest more, you can do so to accelerate this value to an increased return, right? But if you can only afford to invest X amount over, that 20-year period, you could triple your money, right? So the power of compound interest is really amazing. It really is. But let's take a look at the last slide. With the S&P 500, right, we could see bull markets and bear markets that we've had since 1926. So we could see the first bull market was 44 months, market ran up 193%. Bear market happened, which was one of the worst, was 34 months in time, and the market crashed 83%. But what happened following that? The next 167 months, the market ran up 815%. We had a bull market, right? Then what happened? In around 1946, we only pulled back 22%. Of course, that's a crash, but it only lasted 6 months. What happened the next 181 months? Boom. We could see the market ran up 936%. So obviously you could read this chart, right? The bull markets clearly are much more aggressive to the upside and they last significantly longer than bear markets do. And if we continue to go back to our, stock market chart since the 1900s, it's safe to say over the past 100 years, no matter what this country, the United States of America, has faced economically, politically, geopolitically, any wars that have taken place, inflation, interest rates rising, whatever the case may be, we have always went up in the long run. Of course, there have been times where we've been down, 3 years at a clip, 4 years at a clip. It took maybe 10 years to recover from a major crash, from a war, whatever the case may be. But no matter what, we have always made all-time highs in the future. So moral of what I'm saying is the longer you invest, the longer you stand the chance of making your money back and not losing all of your money. Because if you think about it, let's move back to here for a second. If we think about it, let's say we have that $20,000 roughly invested in the market, and the market, let's say, crashes, let's say 90%. Let's just super highball it 90%, right? You're gonna this 20,000 is roughly gonna be worth about maybe 1,000 or two, right? Okay, yeah, that sounds crazy, crazy dramatic, which it is. I agree. But you shouldn't panic because your goal isn't on the next 1 year, 2 years, 3 years, 4 years, 5 years. It's on the next 15, 20, 25 years. And that's not all of your money. You still have a total cash savings of $40,000 to pay your bills. You have an income coming in every single month, right? Everything is taken care of. You have a solid comfort zone. So your investment capital shouldn't be used with emotion, right? You shouldn't think about it with emotion because your goal should be on the next 20 years. Let's take a look back from the 1930s to the 1950s. Let's say you bought somewhere over here, boom, 1950s, you would have had a small gain. From the 1950s to the 1970s, you would have made money. From the 1970s to the 1990s, you would have made money. From the 1990s to say 2010, you would have made money. And of course, from 2010 to, let's say, 10 years to 2020, you would have made money, right? So every 20 years, you could see you would have made money or been close to a break even. There's no way that you're going to lose all your money. So I want to help people eliminate that false conception of, oh my God, if I invest in the stock market, I'm going to lose everything I have. It's so risky. No, it's not. It's only as risky as you make it. So I really hope this video gave people more of a clearer picture about investing, and it really helps them take their financial situation to the next level, and even motivates them to invest a little bit, 50 bucks a month, 100 bucks a month, whatever it is. Investing over the long run is one of the main ways that the rich get rich and the wealthy get wealthier, and anybody can do it. The average Joe can do it. The problem why people don't is because most people lack consistency and discipline to consistently invest over a long period of time. So there it is. I hope I debunked some of the myths and common misconceptions that a lot of people have about the stock market and the risks involved in it. I hope you guys enjoyed the video and found some solid financial value that you can implement into your own portfolios. If you guys have any questions, don't hesitate to drop a comment below or private message me on DM. Thank you guys. Take care and have a great week.